Hello, everyone. My name is Pieter Dree, and I welcome you to the PwC Tax Bite podcast series. In this episode, we're going to talk about China, a very important topic for international business. And to talk about the topic, I invited two experts. First of all, I'm very honored to have Anita Peng with us. Anita is a tax partner in PwC China, and she's also China's consumer sector tax leader, and she's located in Shanghai. Welcome, Anita, to the podcast. Secondly, we have Alexis de Meyer. Alexis is China's business group leader for PwC Belgium and has many years of experience in the international trade and tax system of China. Welcome, both of you. Let's just kick off immediately with this interesting topic. And first, Alexis, I want to ask you, why is it important that we have this podcast today on China's tax policy?
Thank you, Peter. Well, I think it is clear that the world of tax is very dynamic. So with so many initiatives going on, we are quite busy. So the Biden administration released its intentions, and it enabled to unlock quite difficult negotiations at the OECD on the taxation of the digital economy and the agreement of a global minimum tax for multinationals, what we often say Pillar 1 and Pillar 2 debates. Now, aside of the US, the EU is also moving with ATA 3, quite a heavy tax transparency agenda, and many environmental taxes, including the Fit for 55 plan. So in this context, we cannot avoid asking ourselves, what about China? China is today the second largest economy in the world, but very soon, and very likely, it will be the first one. So I'm sure many of our listeners have a China presence. And China is clearly less vocal in these international debates. But I also see that it is very clear that the Chinese government has a roadmap for taxation. And the 14th plan of the Communist Party, of the China Communist Party, covering the period 21 to 25, is the roadmap. And I think we cannot disconnect the tax policy plans from other financial reforms. So yes, there are plans in terms of environmental taxation, in terms of stimulate the economies and specific industries like when companies are deploying big data or integrate artificial intelligence in manufacturing and others. That's very clear. But in parallel, Peter, I think we also see some financial reforms coming. So we have the one on foreign exchange control. There was one on competition law enforcement. We have a new data protection law, new cybersecurity law, just to name a few. So the focus remains the GDP growth. But that tax policy must serve that purpose. So that's very clear. It should be focused on GDP growth in China.
Thanks, Alexis. I think you made it very clear for the audience why it's such a relevant topic to think about this today. And I'm sure a lot of listeners are also looking at China for expanding business and so on. So what I suggest, Anita, Alexis, for the next discussion, that we split it up a little bit, that we first talk about China's inbound challenges, opportunities, and then the outbound situation. And so let's start with the inbound situation, Anita, and let me ask you. I think the 14th five-year plan is now available of the government. What are the key focus areas in that plan?
Oh, thanks, Peter. I think in the 14th five-year plan, the government report showing that the Chinese tax authority has extended preferential policies to facilitate technical innovation, IP localization, and advanced manufacturing industries. So, for example, China originally allows for 75% of super deduction of R&D expenses. And now the report is going to increase additional deductions to 100% for the R&D expenses incurred by the manufacturing enterprises. Also, China rolled out the refund region of VAT incremental credit balance for all industries, and it has certain criteria to fulfill, and also have VAT refund ratio. More VAT refund relaxation has been available for certain advanced manufacturing taxpayers, and most importantly, the scope and definition of the advanced manufacturing industry may expand in the near future. So that these are the recent government policies to encourage innovation and etc.
Okay, thanks, Anita. Interesting focus I see on technology innovation and IP. That's extremely interesting. If you would look at the corporate tax landscape, do you see important trends coming to the business?
Yes, for the corporate income tax, China has continuously improved tax administration to create a better environment for doing business in China. So the tax authority streamlines the procedure of enjoying preferential tax policies. Starting from this year, income tax preferential tax treatment is aimed to apply the concept of retain relevant documents for inspection instead of the historical record filing or pre-approval as requested by the tax authority in the past. So that means technically for any non-tax resident going to apply tax treaty benefit, you don't need to have a record filing anymore gradually. So from technical perspective, that is a very good news. But of course, practically, we do observe that from one province to the other, there may be some difference, but it takes time for the authority to adapt. And also, regarding the current China tax authority, currently they use invoice to control the tax payment. And going forward, with the introduction of the electronic invoice in China, tax authority will more encourage electronic filing, and it will be more focusing on use big data, digitalization tool to prevent, monitor, and control the tax payment. And we are now facing more self-assessment based on a risk factor identified by tax authority in their golden tax systems. And we face more random audit based on industrial characters. And last but not least, from a tax policy perspective, currently companies in China overall have a heavy VAT burden, and over 50% of tax collection for China tax authority is contributed by VAT. So the authority is looking at increase the tax contribution of direct tax and enhance the current direct tax system. And also in the meantime, is going to further improve the indirect tax systems, such as VAT, VAT refund, as I mentioned, and also a reform of the consumption tax is in the way. Back to you, Peter.
Yeah, thanks, Anita. And I think in every survey that we do with businesses and clients, the administrative burden of doing business, not in respect of China, but in general, is one of the key points. So it's interesting to hear about your digitalization of tax administration and so on. If we now look, Anita, at incentives for developing activities in China, are there any important incentives that the audience should take into account?
Right. So China has offered a lot of location-specific tax incentives. Probably you already hear. So we hear about Hainan, we hear about West and Middle area, and also Great Bay Area. The representative locations could be Hengqin because it is recently announced a new regulation as well, and the Shanghai, Lingang area, and etc. But all these locations, they have specific encouraged industries. For example, Lingang, it attracted biotech companies, semiconductors, and etc. And also other incentives could be available for industries that heavily affected by COVID-19, like restaurant industries, travel industries, and also China government, they are very helpful to support those small and medium-sized companies, especially after the COVID.
Okay. That's also very good to keep in mind, of course, the incentives, because that really helps to develop activities. Now, Anita, if we look at the pillar 2, and actually as we are waiting, as we are recording this podcast, we are waiting for news for the inclusive framework on the progress made on pillar 2 and pillar 1. Alexis already touched in the beginning of the podcast also on that point. Pillar 2 will have an important impact also in China, I think. What's your view on that?
Sure. For Pillar 2, I think, like I mentioned, for companies, They located in those special zone where preferential tax policies available, and the companies with high and new tax status, or companies with software status where the 15% tax rate applies, and their effective tax rate may go lower than 15% if there are more incentives available, like R&D super deductions, like environmental related benefits, and etc. So this is something we need to look into in the near future. And secondly, for a lot of companies invest in China or Chinese companies invest abroad, normally they were using Hong Kong or Singapore as a first tier of their outbound investment as the intermediate holding companies. So similarly, the low tax rate might be challenged under Pillar 2. And we all know that in Hong Kong, they have offshore claim tax systems. So this kind of tax systems is going to be challenged as well. So with the first tier SPVs, their intra-group financing, licensing functions, and investment holding functions have to be reviewed as well. So overall, China supports BEPS 2.0. While China still calls for a more respect to the jurisdiction sovereignty during the BEPS review and the monitoring process. And given the nature of developing countries, more flexibility is also essential for them to play on the same level field with the developed countries.
And maybe, Anita, if I may chip in here, you indicate BEPS 2.0. We of course talk about Pillar 2, but we should not forget Pillar 1. And it's true that Pillar 1 in China very likely will be less relevant due to the strict regulatory framework. There is a negative list system, and I already mentioned the cyber criminality data protection law, just to name a few. So all this framework or this landscape makes it very difficult or impossible for a foreign company to be in scope of Pillar 1 in China. So very likely there, when we talk about inbound to China, this is less relevant. But I don't know if you agree with me, Anita.
Yeah, I fully agree. I think only for those like Chinese giant companies, they have a more outbound investments could be relevant for Pillar 1.
Okay. Thanks, Alexia, Anita. That was already interesting and a lot of information for the inbound situation. Let's now turn a little bit to the outbound situation. Alexia, with your day-to-day experience, what are for you the main points for outbound investors in the European Union?
Yeah. Thanks, Peter. My experience shows that the management of many Chinese companies have great experience in dealings and managing their tax affairs overseas. And there is somewhat a difference with the US, because the US and EU sometimes EU is one country because it's one region, but we cannot compare the US and the EU. And there are, I feel, somewhat major differences between the US and EU. And it's not about really the complexity of the taxation systems, but more on the strategic thinking, because each EU member state has a different dynamic in terms of tax risk management, the way to engage, the way to collaborate. So just take this example. I think we all know that dealing with HMRC in the UK or with the Italian tax authorities, well, the dynamics are different, and the challenges as well are different. So I think the main challenges for in-house tax professionals in Europe remain: one, the lack of stability in the tax climate, and two, the speed of adoption of new measures. And of course, both, well, are actually the same challenge. But if you just take ATAD 1, ATAD 2, DAX 6, all the domestic tax reforms, all the digital service taxes that were in the pipeline, well, getting a clear avenue for a sustainable tax strategy in Europe is not an easy one. Clearly, it is a challenge. Now, we talk about BEPS 2.0. So what about BEPS 2.0 for Chinese companies in Europe? With respect to Pillar 1, well, it seems very clear that the Chinese giants, tech companies, or even not tech companies, will be impacted. And my experience with those is quite they operate in a very centralized way. Yeah? So a very centralized operating model. I still even see sometimes agency models in place to penetrate EU market. So clearly, the momentum is here to quantify the impact of Pillar 1, shortlist the number of options, and see how do we address that in the next 5 years plan. Now, regarding Pillar 2, I think I expect that the main challenge as of today, actually, will be to see which jurisdiction will actually have the right to tax. Because it's true that many Chinese companies or headquartered companies are actually not incorporated in China ultimately due to legal reasons. So if we just take like the Chinese CFC rule, I don't think that China will take the lead in the taxation of its giants. I believe that China will be on that side more a follower in those OECD-led initiatives. And as we saw it already in the past, China will very likely deploy the reciprocity principle that we usually find in diplomatic rules. But here, if we look at the BEPS multilateral instrument, for instance, well, China was very keen to apply it, but in a very reciprocal manner. So it is critical, I feel, that the process for Chinese companies also need to look at how they can get a refund, a tax credit, a relief in China. Because, of course, if you get a taxation in Europe and there is double taxation, you must obtain a relief or get access to a credit. And this is somewhat challenging in the past, and we see the situation is better and better, but still there are things there to consider. I don't know, Anita, if you agree with me on this China principle, but getting a refund is somewhat always challenging.
Yes. In overall, China have CFC and China also have tax credit systems all in place legally. While in practice, it's because there's not much like a practical situations, a lot of companies to apply. So historically, getting refund in China is not that easy. And also China governments, they don't really like impose CFC so heavily and so closely. But while with the launch of the Pillar 2, if there's a top-up tax have to be paid in China, definitely we need to see whether the China Tax Authority will review the CFC implementation process. And also regarding the tax credit, definitely they need to implement a more friendly credit systems for those companies for the outbound investment.
Clearly, you see, Peter, that you have a tax which is certain in Europe, but maybe a quite uncertain refund in China. So clearly, tax uncertainty. I don't know, Peter, if I can still have 1 minute for a last challenge that I'm seeing.
Absolutely, Alexei. Go ahead.
Because I mentioned in the intro, I think that the last challenge I see for Chinese companies being active in Europe will be to address the transparency agenda. So just take a good example. We all know, I think, the country-by-country reporting. It was already a first global step, but now Europe is pushing it to the public. We will have the public CBCR. It means that the CBCR report will be published online and will be under scrutiny of the public. So everybody will be able to see the very detailed way on the tax affairs of also Chinese, but also non-Chinese companies. But this is clearly a game changer. And when I was talking about how fast policymakers are, well, taxpayers and advisors, they also need to be fast, because we just finished digesting DAC 6, but we know that the EU is working already on DAC 7 and DAC 8. So you see that the pace, when I was talking about having a roadmap as a business for the next couple of years, is a challenge, clearly.
Okay, thanks, Alexei. And Anita, of course. Very useful insights. I'm afraid we already got to the end of the podcast. That this is what we got time for. In a minute, I will ask you your final concluding thought. Like, what would be your message to the audience for people considering to invest in China, or the other way around, from a tax perspective? What would be your key message? And perhaps let me start with you, Anita. What would be your message?
Hi, I think it's a very difficult questions. I trying to answer in this way. I think in the past few months, probably they were due to certain sudden regulations. The investors in the capital market may be a little bit scared or etc. But overall, I think China government they are very interested in continuously attract foreign investment. That and also the overall investment environment in China is improving, not only from tax perspectives but also from foreign exchange and local government support perspective and etc. Just one important message is that the investment in China. You should pay more special attention on the right industry and the right sector. For those right industry and the right sector, they were particularly welcomed by the local government and authorities. Yeah,
thanks,
back to you, Peter.
Mm-hmm. Yeah, thanks. Clear message. And you, Alexi, what would be your message?
Well, to keep it very short, I would say for Chinese companies in Europe, more challenges ahead compared to the past. I strongly believe that. For European companies in China, from a tax policy perspective, tax management perspective, I see a better landscape today. If you see all the surveys of doing and paying tax and doing business in China, we see that over the past years, the landscape is better if we look at the tax point of view. So that's an important one. And lastly, I think from a tax policy perspective, it is also important that the EU must also consider not only the US, but also look at China. Look at China and what China is doing to also engage much more on a bilateral way there. This is also something, a game changer, I feel.
Okay. Thank you very much both for this. Yeah, very clear messages, very good insights. We're at the end of the podcast, so I would like to thank you for your contribution and for participating, but also the audience for tuning in. And if you would like to stay up to date with the latest podcasts, you can always register for this podcast on Apple, Google, or Spotify, or just monitor the PwC Belgium website. With that, I would thank you all for tuning in and hope to see you in the next podcast. Thank you.